All right. Very popular question for me in 2021. How do I remove mortgage insurance? Since people have gained a ton of equity and people that put as low as 3 or 5% down as recent as 12 or 18 months ago are already in position to remove mortgage insurance, I'm going to create a video that talks about how and when you can do this. Before I jump into it, if you like straightforward real estate mortgage content, please consider liking, subscribing to the channel. I'm a mortgage broker. I put out content based on conversations I have every single day with clients, realtor partners, other professionals who are looking at real estate and mortgage stuff all day, every day. So I tend to think that their opinion matters. Some of their insight probably will be useful to people watching. So let's jump into it. First and foremost, what is mortgage insurance? Or sometimes it's known as MI or PMI, private mortgage insurance. If you put less than 20% down on a mortgage, more often than not, you're going to have mortgage insurance. I know people are going to talk about, I know a program where you can put 3% down or 5% down and not have mortgage insurance. Sure you can, but then you take a higher interest rate or you take higher costs. There's no magic potion that just erases mortgage insurance. What mortgage insurance is, it's for the lender. I hate to break it to you. I've heard all kinds of wacky stuff throughout my years on all kinds of different subjects. Some of the funny stuff I've heard about mortgage insurance is it's insurance for you, where if you don't pay your loan, some entity comes along and pays it for you because you've paid into this mortgage insurance fund. I'm sorry, that's just not the case. Mortgage insurance is in place to protect the lender if the borrower defaults on payments. So the lender says, we feel pretty good about your ability to repay, but since you're only putting 3% down and we're holding 97% of the loan and more of a risk to us, what we're going to do is we're going to collect a mortgage insurance premium every single month for a certain number of months. And if you default, we're going to have this big, fund that we can draw on to say, it's unfortunate that more of these defaulted than the 20 or 30% down ones, but we've got this fund to back that up. And that's going to be different for conventional loans and FHA loans, which both have mortgage insurance. I'll go into that, but that's essentially what it is. And not to be confused with homeowners insurance, which protects you, the homeowner. Your house burns down, you call the homeowners insurance company, they rebuild it. You have to have that homeowners insurance in place every time you have a loan because the lender's in a position where they want to get paid back if your house burns down. Sometimes that homeowner's insurance also covers, the loss of jewelry or other things if you've got that written in your policy. But homeowner's insurance, totally different thing than mortgage insurance. Mortgage insurance, there to protect the lender. Mortgage insurance in place more often than not when you put less than 20% down. So what you all came for, how do I get rid of mortgage insurance? Now, the first thing to think about is whether you have an FHA loan or a conventional loan, because it's going to be different with those two loan types on how you get rid of it. First, I'll go over FHA. How do I remove mortgage insurance? On FHA, I wrote no can do, which is mostly true. You can refinance, pay off your FHA loan, get into a conventional loan, no more mortgage insurance, or if you put more than 10% down up front, that mortgage insurance is going to fall off after 11 years. Most people aren't in their loan for 11 years, so that one is going to be something. And this happened in 2013. Prior to 2013, if you have an FHA loan that's older than that, mortgage insurance would fall off at a certain point. Then after that, they said, listen, mortgage insurance is on there for the life of the loan. You put 3.5% down, it's always on there. This caveat still exists. If you put 10% down or more or refinance at 90% LTV or lower, it's going to fall off after year 11. Your loan estimate will show that. Payments, years 1 through 11, years 11 through 30 over here without the mortgage insurance. On a conventional loan, once you reach 78% loan to value on the amortization schedule, that mortgage insurance is going to fall off. Let me see if I can do some quick math. 500K is what you borrow. 78% of that is half of 780. What's that? 390. So let's say, I'm sorry, this isn't what you borrow. This is what the purchase price was 500,000. You borrowed 450 because you put 10% down. Once your loan amount reaches 390, 78% loan to value based on your amortization schedule, that might be 7 or 8 years in. Should automatically fall off. You might have to call your servicer and remind them, hey, my balance is 388,562. And based on, you know, the purchase price of $500, I'm below 78% loan to value. Please remove my mortgage insurance. Another way to do it is to refinance. And this is something that is more common than not right now in 2021. Want to remove it from FHA? Refi. Want to remove it from conventional? Refinance. In like an interest rate environment like we're in now, where you can do a refinance and get a 2.6%, it makes a lot of sense. Take the mortgage insurance off, go down to a 2.625, pull cash out, still keep it under 3%. This is really common. Where it's going to be different is if you watch this video in 2024 or 2027 and rates are a lot higher and you're not necessarily wanting to refinance because you have a low interest rate, you want to remove mortgage insurance without refinancing. And that's where you're either going to want to do this and pay it down to 78%, or depending on the lender, you can tell them, hey, I bought for $500, I borrowed $450, I've only paid it down to $436, but it's worth $550 now. So now I'm in a position where my LTV, this is actually 80 with a lot of lenders. My LTV is less than 80%, but based on a new appraised value. They will either do an automated value system where they just say, okay, our automated system agrees it's $550, or they'll send by an appraiser. Something to think about there with asking your lender to remove mortgage insurance. A lot of them are going to require you've had it for at least 2 years. So you can't buy in February, call the lender in October and say, hey, I want to remove mortgage insurance. My neighbor just sold for 1.1 million and my value is higher. A lot of times there's a minimum threshold where they want you to pay 24 months minimum or 36 months minimum. So you got to check into that. But that's a couple different ways to do it. Like I said, refinance is more common than ever just because rates are so low. That's probably not always going to be the case. But certainly in 2021, if you've bought 2020, 2019, 2018, most places across the US have seen massive increases in value. I mean, year over year, 15, 17% means that you bought and you only put 5% down, all of a sudden you have 22% equity. If you're in a position where you qualify for a refinance, you probably shouldn't be paying mortgage insurance. Even if you got a smoking rate sometime in 2020, there's a strong possibility that you can tick that down a little bit and remove a couple $100 in mortgage insurance. That's going to pencil. You're going to talk to a quality lender that's going to just do a cost versus benefit analysis and say, listen, we're going from a 2.9 to a 2.71. We're going to remove mortgage insurance. This is going to save you $250 a month. All in, total loan costs are only going to be $2,700. Therefore, this thing pays for itself within 11 months. If you're staying here for more than 11 months, this deal makes sense. Green light, refi, proceed. Or in some cases, maybe it doesn't make sense, or maybe you're not quite there. Maybe you look at a scenario and say, you bought for $900, you put 10% down. Yeah, it appraised for $950, but we're not quite there yet. I think it might make sense to wait a little bit longer. Another thing that I didn't mention, and I just popped in my head, is that even in cases where you might have 15% equity, where you've got a house that's worth $500, and to have 20% equity, it would need to be a loan amount of $400. Well, maybe you owe $420 and it's worth $500. So you're not quite there yet. There might be a chance to do what's called lender paid mortgage insurance, where you buy out. And the closer you get to 20%, the cheaper that buyout is. So a lot of cases, you might go from 3.25% on your current loan with a mortgage insurance payment to 2.81, where if you had 20% equity, you can get 2.72. I'm just making up numbers. This isn't an offer to lend. This isn't anything, but a slightly higher rate buying out the mortgage insurance. And you get into that, you set it and forget it. So moral of the story, if you're paying mortgage insurance, your house is appreciated in value, reach out to a lender you like and trust. If you're in California, I'd love to help you out. Reach out to us, Matt at mattthemortgageguy.com. If you're outside of California, a quick, simple form, greatmortgagebroker.com. I'm going to connect you with a mortgage broker in your state that can help you out. Thanks for watching. I appreciate you. We gonna see.